We are going to be talking about syndication, right? Real estate syndication. Who has heard of that? Okay.
Good.
All right.
Good.
All right. Well, no further ado, I'm going to go ahead and introduce Reyes. Come on up, sir. Let's go.
All right.
I really don't play music, man.
Yeah, I asked him to play the Rocky song, but we'll get it next time. We'll get it next time. All right, awesome. Thanks. What an event. I mean, good gracious. I guess one lesson that I learned a lot from Steve, but probably the biggest lesson is probably never want to speak after Steve speaks. That's just tough. That's a tough game. It's all right, man, but no, it was great lessons to be learned. I mean, there's a lot of good stuff. What I like about these type of events is it's not just focused on one thing, and you can get a broad exposure to a lot of different things. And as you'll see in my presentation here, I actually, if you look at all these logos here, it looks like I'm all over the place. But the reality is that if I go to the next slide here, first of all, I'll have a disclaimer because my attorney says I need to have a disclaimer when I talk about syndications. So it's a little bit there. This is not to sell you guys anything. I'm not selling any syndications in this presentation, but we still have it. But the biggest thing I want to mention when we get into the actual slides is that we are all real estate entrepreneurs. I think you use a vehicle that works for you to do your business, whether it's flipping, whether it's hard. I saw there was a lender here before. There's the people that are doing some of the other things with the insurance. But essentially what we're all trying to do, and I think Steve was talking about this, right? At the end of the day, what is the business? The business is where we want to end up. And we're using all these vehicles to create wealth. We're going to talk about syndications in this presentation. I was surprised that a lot of you at least have heard the term. So I wanted to keep it broad and not so specific, but if somebody's got a very specific question and you want to jump in a little bit, I'm happy to answer specific questions on syndications. But I'm going to keep it broad for now, and then we can go from there. Make sure I got this right. All right, a little bit about me. And my better half, Marilyn, is back there. I was raised in Milwaukee, Wisconsin. I was born in Puerto Rico. The reason we moved to Milwaukee, Wisconsin from Puerto Rico, as I was told, it's a lot of jobs. And it was the cheapest ticket to go from Puerto Rico to the States. And so we were raised there. I'm a cheesehead. My kids are grown now. That's why a little bit, it's been a while. My youngest is 21. He's in the Army. Now, I was in the Army. I did 28 years in the Army. This is a picture in Afghanistan, 2001. Right after we were essentially in Afghanistan, September 11th, January 2nd, we were in Afghanistan. And so I was a captain there. I don't have it in this presentation, but I don't have the picture. Obviously the beard is because I used to travel in my job as an intelligence officer. I used to travel and have to go to liaise with other units and other intelligence professionals in the area about what the threat was. And so I had to have a little beard, and of course, I'd obviously cover myself. But I had thought that when I retired, I was going to have this beard like this, or maybe a little bit neater. But the problem is, it's fully gray now, so I don't wear a beard at all. My wife said, "You're not going to do that." But in this picture, it was kind of a neat picture. And then this picture here is this is Admiral Craig Fowler. He was the Southcom commander, my boss, in my last job at United States Southern Command in Doral, South Florida. I used to travel with him, and I'll talk a little bit about why I retired, honestly. But I used to travel with him to meet with leaders in Central America and South America, which was the area that he was focused on, as Southern Command is focused on. And he met with the presidents of countries, and he didn't speak the language. I did. So I was there with him. I was there to advise him on that. But the problem with that job is that I couldn't do anything else. Essentially, the commander called, and I had to kind of go. And I always had this itch about real estate, and I did a lot of single-family stuff while I was in the Army, but I wanted to kind of take it to the next level. Whoops, going the wrong way here. Let's try that again. Whoops. Here we go. All right. Again, talking about what I consider myself, and I think what you all should start thinking about is that you're entrepreneurs, you're real estate entrepreneurs. You're in real estate as a vehicle to create wealth. I've got several companies that I'm partnered with. Others, I have the Admirable Group, which is a joint venture entity where we get together and essentially a group of us actually go and invest passively and actively in syndications. REI Real Estate is essentially the company that I use to run operations from, separate. And we talked about the different LLCs. That's kind of the company that I use for all of the processing and the paying and everything else, and my marketing efforts. Everything runs out of REI Real Estate. And then recently we created Stressless Capital. One of my partners, Kelly's back there. Essentially, that's a real estate investment fund, and we use a syndication. It's a 506C, and we'll talk a little bit about that. But essentially, we raise capital into the fund that then is able to invest in syndication deals. We'll talk a little bit about that. I also have a virtual show that I run monthly. Run out of, it was great during Zoom because a lot of people, there was no full live events to go to, but I'm finding that live events are just better to connect with people. But I still do that show, and I get people from all over the country, in Latin America and even Canada that pop into the show, depending on the topics that we run. And we try to run, it's educational. It's about, okay, if I'm an investor, where do I invest? Talk about insurance issues, talk about state of the market, and all these sort of topics that are good. So we get people that come and go from that. And I wrote a book. Part of writing a book, and it's kind of, it's about passively investing in multifamily. And I'll talk about multifamily a little bit more a little later. But I think the key is that this book is useful to people because if you're a passive investor, great. You get to talk, you get to learn about syndications and multifamily from that perspective. But if you're an active investor, if you're actively trying to be a syndicator or an operator, then you can use this to reverse engineer, because from this, you're going to figure out what people are want to know. What are your investors, if you're actually going to be an active participant, what are your investors going to be interested in? How are you going to protect them? What are their pain points? We talk about that when we talk about marketing and who you're talking about and who you're trying to raise capital from. What are their pain points? We call we also use the term avatar. Who is it that you're talking to that is going to want to invest with you into these deals, right? So you can actually reverse engineer that, and it works well for both. I'll talk a little bit about just the multifamily that I've done since I started investing in 2005, but really in multifamily since 2016. And I started out as a passive investor. My last job, I said I worked for the commander at Southcom. I did that for about a year. But before that, I was the Army attaché, U.S. Army attaché in El Salvador. And in that job, I was literally at the beck and call of not just the ambassador, U.S. ambassador there, but also the country, the military commander of El Salvador and people on his staff. There was no way that I was going to be doing any kind of active real estate investing in that job. There's just no way. And so I started out passively. But the other reason I did it passively, for those that are potentially thinking about doing this as an active syndications, not just passively, is because it allowed me to learn how the business worked. I already had an idea, like a lot of folks here, we've been doing something with real estate in our lives, either investing in single family or some other way, right? Fix and flipping. So there was already some methods and some things that I understood about doing that, but I wanted to make sure that it translated to syndications and multifamily. All these properties that you see on the screens here are all deals that we bought and sold since I became an active, since 2016. We typically try to hold these for about 5 years in a syndication, but doesn't necessarily work out that way. Sometimes you got to look at the market and see what's going on. In these deals here, the average annual rate of return that we provided to investors was 69%. 69%. Some of these, the second one, the Green Meadows in Augusta, Georgia, we held 13 months. And we only held it 13 months because I didn't want any short-term capital gains tax. So we wanted to make sure we hit the long-term capital gains of 12 months before we sold it. That property did very well. I mean, what we tell investors, and I will mention that I'm going to be doing potentially more consulting in the future. I honestly haven't had time to do a ton of consulting. I do educate through video. I've got, you'll get a link at the back end where you can see all the stuff that I've got posted. But I'm considering doing more formal consulting. At this point, it's been more, I let people call me, and you'll get my contact information. I got no problem talking to anybody about this because I'm very passionate about this business. Like a lot of real estate people, we just love it. This is the current property that we have, and the reason I bring this up is if you guys want information on it, this is for accredited investors only, but you can get the information from there. But what I want to point out is when I talk to people, you see the internal rate of return is about 16-17% on this deal. The annual rate of return is about 20%. So what we try to do when we're working with investors is we want to give them numbers that are a little bit lower so that we overperform when we actually deliver on their returns on investment. But the last thing you want to do is put on here 30% AAR or higher annual rate of return, and then you get them a 20%. That's fantastic, by the way, but they're going to be like, hey, you told me I was going to get 30%. So we make sure that when we run our underwriting, we do our work, that we actually bring that down a little bit to make it more achievable. And these are still great numbers. And I won't talk about all these things as far as what they actually mean. I will mention that preferred return, typically when you we have a preferred return, that means that the passive investors get 10% of total return before the active investors get any money. It's a way to basically stress the system to allow for the active investors to want to overperform. So it's built to basically make it win-win. When we do well, obviously that means the passive investors did very well. An equity multiple, when you have a 2x multiple, that means that let's say you invested 50K, an equity multiple is 2x, means that you got back 100,000. So you double your money. That's typically when we talk about some of these terms. But again, if you learn these terms, it's not much different than when you're looking at single families. It's just a little bit different language. Syndication, and the thing that I wanted to kind of stress is, to me, is a creative financing technique. I say that because I also, with partners, including Kelly, invested as a joint venture in a 24-unit townhome property in Ocala, near Ocala here. And it was not passive investors. We're all active investors in that deal. But the syndication allows you to do is allow to bring in other people's capital to bear so you can go bigger. And we'll talk, I know that even earlier some folks were talking about, Felipe was talking about LP versus GP, and we'll talk about that as we go into the nuts and bolts here. But that's all I want people to think about when they think about syndication. It's a method to come up with capital. And by the way, even for passive investors, like if you want to be a passive investor and you don't have the money to invest in these deals, and it could be 25K to 50K, your typical investment. If you don't have that kind of money, create an entity and bring somebody onto your team that does. So you can do that, and now your team is investing in a deal, whereas you potentially couldn't do it by yourself. So it's all about opening up the mind a little bit and figuring out how you can be in the game. And it's a fantastic thing to be able to get into these deals, because I think where this differentiates from a lot of different type of work is that it's really passive. And I can't stress that enough. In most deals, and I'll give an example. This is a real life story here. When we were, as I mentioned, in my career, I've invested in single family along the way. Every time we'd move somewhere, we'd buy a property, and we kind of grew our wealth that way. One of the properties that we had was in San Antonio. And I remember we were, at the time, my wife and I were in Mexico City. We were working out of the embassy in Mexico City, and we had a property manager that was managing our property. Fantastic. Problem was, the tenant became a little problematic. The property manager said, I quit. Shoot, that's a passive investment, I thought, right? I got a property manager. Well, guess what? Now all of a sudden, my wife she was working out of the embassy too, working in one of the offices there, had to take some time off so she could go deal with this problem, because essentially we had tenants there, they were threatening to sue, it was just a very difficult situation, and a passive investment became an active investment really fast. So I say that, so in the multifamily, when you get into syndications, you actually have another layer of support that handles property manager stuff. So you, as a passive investor, if that's what you want to do, you don't have to deal with any of that. You get reports, you get to review how the property's doing on a regular basis, but you don't get to deal with tenants, you don't get to deal with anything. You just essentially are able to reach out to the operators on that team to ask questions if you have questions about the property. I like multifamily over single family, and I think somebody else I was talking to, kind of it resonated with me when I was talking to them about it, the reason why. It's the scalability. I wasn't getting any younger. I'm not getting any younger. I retired. I was already close to 50 when I retired. I'm like, I don't want to buy a bunch of single family houses. I don't want to fix and flip. I don't want to do none of that stuff. It's too slow for me, right? If you've got time on your hands, maybe you start out that way. But in my place where I was, I needed to scale, and I needed to scale quickly. So that's why I really like multifamily, and syndication allows you to do that. The other reason is essentially, they talked about cost segregation. That's great. That's fantastic that they're actually doing that on some single family. Some people find that cost segregation is a little bit cost prohibitive at the single family level. There's a cost to that. You have to bring in an engineer company. So I definitely want to understand more about what Felipe said, if it's something you can do at the single family level, because it is a terrific way to protect yourself from Uncle Sam in the short term. But the other thing I like about it, just from a risk standpoint, I'll talk about that. Think about this. You have a 100-unit property. You have 10 vacancies. People skip out. They don't pay. They're sitting there. Maybe they don't want to leave. Whatever the case is, you've got 10 non-performing tenants in that property. What's your income? What's your rental income? Not a number, but a percentage. 90%. Try that on a single-family house. Duplex, quad. You get one or two people that move out or leave, you better have some money somewhere to pay, to protect yourself. And then when we did single family, that's what we did. We essentially were our own bank for those kind of things. And I would keep at least 3 months of expenses and payments, mortgage payments, in case we had an issue. And we did that for every property. In a syndication, you don't have to do that. You don't have to do that. You put your money in, and then there's reserves built in within that structure to allow for any issues that come up, that reserves gets tapped out first. And depending on how that deal is structured, most deals, I haven't been in a deal yet where we had to actually call investors and say, by the way, we need more money. Not that it can't happen, it may happen. We've never had that happen because of the way these things are underwritten very conservatively to make sure that we don't do that. Because the last thing we want to do is go back to investors and say we need more money. But if you had single family properties, you're doing that all day. Let's be real. You're doing that. So that's why I like multifamily. You're just able to to have a little bit less risk, and then you buy one multifamily, you have a lot more doors. You're able to scale much more quickly in a business if you want. All right, so now let's go talk a little bit more now specifically about syndications. You guys, most of you know what it is. Essentially, it's a combination of passive and active investors. Most of your active investors are a small group. It could be 5 entities, 6 entities that are sort of what's called the general partnership, and within that general partnership, you may have 1 or 2 entities that are actually managers of the active operators. So the other members of that general partnership provide input, are involved, but they're not decision makers. So even within that, you have some structures above and below on the active side. On the passive side, it's very simple. Essentially, all of the money that's used, that those investors provide capital for, is provided for the purchase of that property. And this is where it also is a little bit better for the passive investor, because the money that is used for these deals are only for the purchase of that property. So if you guys have done single families before, you've gone through that process of buying a house or whatever the case is, you're doing due diligence, you're doing inspections, you're spending the time finding these things and money, you're using marketing to get these leads, you're doing all that stuff, right? And that costs money. And if you don't close, you don't get any of that back. It's lost, it's sunk cost in your business. And if you've got a good strategy like Steve talked about, then you understand exactly what that cost is, and you can kind of work with that. But as a passive investor in these deals, your money is not touched until we close. Your money is specifically for closing only, and there's no risk to you if you don't. If we don't close on a property, and we've had it where we were in a deal in Buckhead, Atlanta, and the deal never closed. We collected investor money, and we're sitting there, we're trying to get this deal closed. It was in the middle of, right after COVID. It just didn't close. We ended up returning that money back to investors. That's it. So the only cost to the investors is the holding cost for the time that money was not being put to use somewhere else. But it wasn't like we used their money and that we used their money to supplement any due diligence costs, loan costs, or anything that we had. That was something that we took on the operator side. Operator and syndicator form an entity, the entity then invests. Why is that important also from a risk perspective when you talk about, we were talking about different LLCs and the fact that, from a protection standpoint, you can be sued. If you're a passive investor in this, your name is nowhere in this document. So they can't go after you as a passive investor. In most of these deals, these are what's called non-recourse loans. Sometimes you can do recourse loans, but they're normally non-recourse loans. But even within the non-recourse loans, the operators have to have some skin in the game. The lenders will want the operators to have some skin in the game. So we have to put money into these deals. And then the other thing is, if in fact we do everything legally and the deal goes bad, okay, well, essentially that deal goes bad, they can't go after me as an operator personally. However, if there is any kind of fraudulent activity that happens, they can go after me. And they do, and they want the operators to have a certain amount of liquidity in their bank accounts. Every quarter, operators have to provide documents saying, here's how much money I got in case something goes wrong. Because if there's any fraudulent activity, I'd imagine it's kind of like insurance. They're going to want to try to go after people. So we call them bad boy carve-outs. Essentially, the lender will come out in the language of the deal. They'll look for ways to say, well, if you do this wrong, then we can go after you. But the only ones they can go after are the active team. They can't go go to the passive investors themselves. So it's just another level of protection. So when I say passive, it's passive. And then obviously the syndicators do have a lot of work there. And what we do on our team is we actually do both. We are actually on the operator side. We find the deals, we get involved, we do the asset management. But we also invest passively in these deals because at the end of the day, what I'm trying to do is I'm trying to build my wealth too, right? So I want these deals to perform well so that I can get money, but I'm also going to be a passive investor in these deals, and I put my personal money in as a passive investor because it accelerates my ability to generate wealth. If I'm able to turn 60% returns on my personal money, in addition to what I'm doing on the active side, it's fantastic. I guess in the single family side, it's very similar. So if you do a fix and flip, so long as you take some of that money that you make in that fix and flip and you make it and you put it into an investment, then it's kind of similar. But the idea is that you're always growing your wealth so that if someday in the future you no longer want to be an operator, you no longer want to work, you still have your passive income going. And so that's the beauty about doing both. Not that everyone has to. Some people just want to invest passively. They love their job, or they want to spend more time with their family. If they're older, some of my avatar, right? When we talk about who are the type of people that invest in these deals, they're typically people that have a significant amount of money, and they just don't want to deal with anything anymore. They're just like, listen, I want to just place my capital. I want to offset maybe some capital, some income that I'm getting. So I want to be able to get some tax benefits from it, but I don't want to do anything else. That's the perfect for these folks. So 40, 50-year-old folks that do that. Also get a lot of landlords that are tired. And they're like, you know what, I'm done dealing with tenants. I mean, it's fantastic, it sounds great, and if you've got the energy and you're pretty good at it, great. But at some point, maybe you just want to just earn money, use the vehicle, but not worry about doing the work. And do what you like to do. All right, so let's talk a little bit more about how the splits are really between active and passive investors. This is just a typical split of the money that's invested. Typically, the passive investors get 70% of the deal. Could be 80, could be 75, but it's typically about 70% of the deal. The active investors or the operators get 30% of the deal. There's also some fees that go along. Obviously, we do asset management. It's not an exorbitant fee, but there is work that we have to do on a regular basis. We meet weekly on these properties going over, we're dealing with any issue. Question, go ahead.
Obviously, if it's just like a normal property, you're just charging like the 8 to 12% on that, or
Say that again?
for the asset management?
No, the asset management fee is typically about 2%. 2%. So, and it's after you pay, after you pay all expenses on the property, and after you pay property management, whatever's left, you get a 2% of that.
Okay, so this is like managing the asset after the property management is already doing their job.
Yes, because if you think about it, right, and I kind of mentioned this, property management, nothing against property management, we all need them, right, at some level. But property management doesn't care about your NOI, how much money you make. They really just want to keep the place full, they want to keep it clean because that's their job, but they don't care about how much money investors make. That's what asset managers care about. So when we decide whether we're going to replace something or repair something, the decision in the back of the mind is, okay, what's the best course of action to make sure that we get the best return on that investment? So it's a little bit different mindset. And like I said, the property managers, we've fired property managers before. You go into a deal, you think these are the folks that you want to work with, and then in the process of that, you figure out that they got some other issues, and we've had to fire some property managers. So that's in and of itself is work when you have to switch property managers, et cetera, as I mentioned. And even at this level where you got more professional property managers, essentially you're able to bring in payroll. So you have property management, their fees are much lower. It's like 3.5%, 3%, but you're bringing in some payroll. So you have in-house people in these properties making sure they're watching. But even then, it's still a lot of work. So it's a reasonable fee. And that's good that you mentioned about the fees, because the reality is, the biggest fee that an operator gets in these deals is an acquisition fee. Sometimes the disposition fee is next. Acquisition fee means purchase price was $1 million. Acquisition fee is typically 3%, 2%, depending on the deal. The larger the deal, actually the lower the percentage. But say it's 3%. So it's 3% of the purchase price. You're splitting that amongst all the operators, right? The ones on the active side. So it can be a lot of money. But what I tell investors, because especially when they start asking about this, like, that seems like a lot. But think about all the deals that we didn't close in order to bring this one to you. So that's how the operators are able to stay in business, because they get this fee. And the disposition fee is typically one it's disposition, but it can also be on a refinance. It's typically 1%. So when you refinance a property or when you sell, some of them will have disposition fees. It's a good point that you're making. We'll talk a little bit more about the forms and the documents later, but each deal is a little bit different. And so you have to actually look at the actual private placement memorandum as one of the key documents in these that investors have to review, and it tells about what these fees are. But what I stress to investors is your return on investment, what we're telling you you're going to make, is already baked in. This is already baked in. It's not taking from your return. It's already in the underwriting. So, just a simple example here of how that split 70-30 works. Let's say you buy a property, it was $1 million. Passive investors put in $250K. The biggest client is a lender, puts in $750K, right? And at this point, we were looking at about 5%. Right now, the one that you guys saw before in South Dakota is 5.85%. So it's higher, but it's not that much higher. You normally get decent rates on the multifamily side. But if that's the case, in year one, net operating income is what? It's your operating income plus other income minus your expenses. So let's just say that your NOI for year one was $70,000. That's what's available to potentially distribute. How do you distribute that? Obviously, you pay the loan. You got to pay the loan first, pay the debt, and then here's your 70-30 split, how that would work. If you sell in year two, let's just say NOI went up by 20% because you raise rents. I mean, a lot of these places you can bump rents $100, $150 each unit. Multiply that by 100 times 12, right? So numbers are a little bit bigger. So you just say you raise NOI by 20%. It's kind of how this breaks out on the back end, on the total return. And so it's a good multiplier. And again, if you're a syndicator, this is probably not one individual. This is a group of individuals. So I don't want people to think like, oh my God, I'll make $70,000 by myself. Well, it just depends on how big your team is. But this is a small deal. I mean, I'm talking $1 million. The deal that we're looking at, that we just closed in South Dakota, actually closed, we raised $20 million for that deal. $40+ million purchase price. So it's a significant amount of money. So this is an easy example to show that, how that would break out. This is just a summary of how it works. Again, syndicator does all the work. Investors put the majority of the money, although some syndicators will put money here as passive, like we do. And pretty simple here. The lenders, the one thing I'll say about this, I mean, obviously there is a scale factor that I like, but they can be a little bit more complicated, and we'll go into that later. There's a little more complexity because you got, let's just say, just from an attorney standpoint, you've got the attorney that's representing the buying team, right? The people that are acquiring the property, the syndicating team. That has in a syndication, you have to have a securities attorney doing the paperwork to make sure that you can raise that capital. You have to have an attorney that's actually going to close the deal. They're typically not the same. You have a securities attorney to do all your paperwork, to do your syndication, then you have a real estate attorney that's doing the closing. The lender will have their own attorneys. Lender has their own attorney. The seller has their own attorney. And so these things can be a little bit more convoluted, and you do need that protection into doing them. But at the end of the day, if you can do that instead of buying, if you can buy 1 unit, 100 unit property, instead of buying 100 single family properties, that's the benefit of it. All right, so we'll talk a little bit, this is just an overview slide. There's about 7 steps, 7 phases. Some military people would call these lines of operation, if you will. These are things that you, from a syndication standpoint, if you are an operator, have to worry about. So these are things that and we talk about systems and processes. These are all baked into those. And we'll just go into them very quickly because I know we're a little bit short on time, but formation is probably your most important if you're an operator. I mean, it's like when you buy a single family property, you don't just go pick a place and just go buy there. There's a reason why you're doing that. You probably already have some money that you potentially have or at least a strategy to buy that property. You probably have some attorneys. All that stuff, you may even have a company, depending on how sophisticated you're doing on a single family side, but you have all that stuff. It's the same thing on a syndication, except you just have more pieces to play with. Again, I talked about the different attorneys that you have to have, you have insurance people that you have to deal with. There's a lot that goes in, and then you have to create the entity. There's a lot that goes into that formation phase that passive investors, they may want to ask about it, but they really don't have any there's nothing that they have to worry about. I have had passive investors ask me, okay, who's on your team? Talk to me about your team. And so then you have to talk to them about who are all the people on your team, who's your property manager, why you like your property management, who's your securities attorney, the type of the deal. So you may have to talk to them about it, but by the time they're involved in the deal and you're putting something in front of them, this has already been done. This is just baked into your business.
Can you join a syndication as an LLC, or would I have to join it like as Haley Ray?
Good question. We have several ways that an investor can invest in these. You can invest as an entity, LLC. As I mentioned, if you want to create a joint venture of active, partners of yours, and you all invest into, that entity then invest, you can do that. You can invest with self-directed retirement accounts, whether it's FDIRAs or solo 401ks. You can also invest as an individual. And the reason why it's not so worrisome to invest as an individual is because, again, it's got inherent protections into a syndication that you don't have to worry about, lawsuits. That's not something you have to worry about. Does that answer your question?
Yes.
Okay, good.
So I want to go a little bit more about what you asked. Let's say if I had, friends, family, and we all want to put 50 grand into, let's just say LLC, and then invest in the syndication. Is that what we would do, or do we go straight to you, or?
Good question. I coach people on how to do that. Because I talk to some people, and honestly, 50K is a lot for some people, and I understand that. So I'll talk to them about how to do it. But I think this morning you had the partnerships. Ashley talking about partnerships. I think within there you probably have it covered. But essentially, what I recommend people do is they find some partners that they're willing to work with, figure out what their roles are going to be, because everybody in that entity has to be an active investor. That doesn't mean that you're doing all this work, but it just means that you have a purpose within that company that was formed. So somebody maybe provides all the capital or the majority of the capital. Somebody's doing the bookkeeping. Maybe somebody's doing some of the paperwork. Everybody's voting depending on the threshold of things that on the passive side there's not much really to vote on, but there are some decisions at the company level that you maybe make. And there are some entities, honestly, that you don't even have to have meetings. You want to make sure. So it depends on the type of entity, but essentially you create the entity. And you figure out what the best way to, how many people. What you don't want is to have a syndication within a syndication, right? Everybody has to be actively involved in that in some way. Otherwise, you really needed to have a securities attorney create a syndication for you. Sometimes you'll hear the term, of those that have been in, that know a little bit about syndications, you got a fund of funds, right? That's what you don't want to be if you're creating an entity to be passively investing and maybe even to be a general partner in some of these deals. Fund of funds means that you have your own 506B or C syndication that allows you to raise capital to place in other deals. Not your own deals, but in other deals. So there's definitely some ways to do that. But I can talk to you about that, but honestly it's people that you obviously feel comfortable with, and like they mentioned, even then you got to have your protections in place. You have to have an operating agreement and these sort of things. Okay. Any other questions? Good questions. All right, we hit formation. Fundraising, when I talk about fundraising, I talked about how the loan is your lender is your biggest client in this. I mean, they're providing the majority of it. And the other thing that is very good about syndications from that perspective is lenders are looking at this also about whether it's a good deal, right? So they're doing their own underwriting on these. And if they don't lend you the money, there may be a reason why they didn't lend you the money, right? Because they're in it to make money as well. So the lenders are doing their own underwriting and taking a look at the financials of the seller's financials and what the buyer's business plan is going to be before they determine whether they want to lend you the money. Because again, these are non-recourse, a lot of these loans. So that what they have is the value of that property, and that's what they lend on. And then of course, and when we talk here about fundraising at this level, really even before you find the property, if you're thinking about doing this actively, or if you're maybe wanting to partner with a few folks, you got to figure that out. How are you going to get the capital to do these deals? So we have what's called a way to get people to soft commit to deals. All that means is like, hey, listen, this is what I'm doing. We're looking at deals that meet this criteria, whether it's a return criteria or a geographic criteria or both. Some criteria. Is this something you would be interested in investing in? If yes, how much you think? Or do you know anybody that would? I like that. That's something that I always tell people is like, sometimes don't ask them like, are you going to invest? Like, do you know anybody that would be interested in investing? Then you get soft commitments. Because what you don't want to do is get into the next phase here when you're actually, you don't want to get into this phase. Let's just jump here into the acquisition phase and not figure out you don't have any money or people or teams. So even before you find a deal, you got to do all this other stuff. Let me jump back to this slide here real quick on prospecting. This is where you're actually looking for deals, right? So you're looking for deals, but you don't want to get there until you actually have some structure in place into how you can raise the capital. They say that the easiest thing in syndications is raising the capital. There's a lot of capital out there because we not only raise from individuals on the deal that we talked about, the $20 million raise, $9.5 million of that was a REIT, a real estate investment trust that was placing $9.5 million into that deal. So it's not just retail investors, what we call your typical passive investor, where they're investing, maybe 50 to 100. There are some capital groups out there that invest a lot more. Like I said, I have a fund that's placing capital now in other deals, and we place higher amounts of money as well. So. But at the end of the day, you have to have at least a structure by which you're going after this. And a lot of people make mistakes. If you're on the active side and you want to be an active investor, an operator on this, everyone's like, well, I want to find a deal. I want to find a deal, and I'm going to talk to brokers, and you're thinking about in your head about all these things that you're going to do. But the problem with that is there's also a scarcity of good deals. A lot of people selling properties there, but are they going to meet your criteria? Just like on the single family side, do they meet that criteria that you're going to be able to provide those investors what you're telling them? So what is harder, finding the money or finding the deal? They're both hard. And you have to have an idea of both. But if you want to start in the operator side of things, find a partner that is an active syndicator that maybe is looking for some help in some way to form out their team. Or maybe they're growing and now they need some additional, they have some additional requirements. So now you can potentially get into a deal that you didn't find. And you can get a portion of that on the active side. And I'll talk to people, I don't know, January is kind of the month where people start, reminiscing about what they did or didn't do the previous year. Man, those 50 pounds or whatever, right? And it's the same thing with money, right? Like, man, I should have done that deal last year. And I talk to people and it's like another year and they haven't done it because they're trying to do it all themselves. This business is a partnership business. There's too many aspects of it for you to do by yourself. So find what you like, partner with others that have other likes and dislikes, and that's how you go after these things. For example, I learned how to underwrite. I signed up for programs to do that, but I don't like underwriting. I can't sit in front of a computer for 8 hours a day, 10 hours a day underwriting properties. But there's some accountants out there and some analytical folks out there that they don't want to talk to people. They don't want to get up here and do this, but they'll sit on a computer all day and do their thing. So find those folks that can do those things that you don't like to do and fill those spots on your team. And so that's always critical when you're doing this. Acquisition, this is really at this point in the process, investors, you already have an idea about the investors, and really you start putting this, and a lot of this is actually for the bank and for the lenders. It's not so much for the investors. The investors see some things. What an investor normally will get is an offering memorandum, a private placement memorandum, sometimes they call it, but it's basically the document that says here's how your investment is going to be used, here's what recourse you have, here's what documents you're going to be provided, here's when you get distributions, because there are distributions as part of this on these deals. Essentially, after the first 6 months, typically most deals will start paying out whatever is left between the, you have the expenses, as I mentioned, and once you pay off the expenses and you pay all the bills, whatever is left that's income gets distributed out between the active and the passive investors. So they're going to see all that stuff, but a lot of this is really for the bank.
Can I ask a question?
Yeah.
Could this be a way for foreign investors to avoid paying the FERPTA tax?
So that's a tough question. No, it's not how they avoid it, because essentially when I have an investor, I have several investors that are foreign investors. What I have them do is to create a U.S. entity. So I don't have foreign investors directly investing in this. They essentially, because you can have a U.S. tax ID and not be a U.S. citizen or resident. So no, but that does complicate the deal, because now when you're doing distributions, especially if you have a fund, you can't just willy-nilly start doing distributions. You have to be concerned about and figure out how much money you're going to withhold for that FERPTA. But no, they wouldn't avoid that. The way that they avoid FERPTA is by going offshore and getting into a corporation, and the corporation invests, and then they get dividends. And so that I typically don't. When somebody starts talking about what's the best way for them to invest in their foreigners, I typically refer them to specialists that do that, CPAs, folks that's what they do. They help them create the best way to protect their assets, just like us. We want to limit our exposure to taxes. Same thing. And so, but we typically, when they get into a syndication, it's because they have a U.S. tax ID. At least the ones that I'm doing. Okay. Much more here on acquisition. I won't go into this, because it is a lot. But typically from a passive investor side of the house, all they really are getting is updates on when the closing is. We typically have when we do these contracts, you normally have 1 to 2 extensions built into the deal. They always, and recently the lenders have been slow. So like even if you've got all the money and you're ready to close, the lender is slow. We had one deal that was supposed to close, what was that, Kelly? It was supposed to be October. Beginning of October. It didn't close till December 20-something. It was like, well, wait a minute, we got to close this year. We told investors that they were going to get a return, they were going to get cost segregation and all these things. If you roll that into next year, then that's going to be a problem for their strategies. But it was all the lender. It had nothing to do with us. The lenders were just backed up. But yeah, so we just keep those folks informed. A lot of documents here. So imagine if you're just one person and you're trying to do all these things. It just doesn't work. but a team can handle this stuff. Then you go into the operations. And again, here's where, honestly, a lot of syndicators fail. Because when you talk, especially some syndicators that are trying to grow their business, they would talk about 10X and they talk about how they're going to grow their business. But the first thing that they do is it's kind of like the contractor that is going after and fixing whatever they're fixing. They get the contract, and then all of a sudden you had a 5-man crew, and now all of a sudden there's only one person there, and now go chasing the next contract. Well, who's doing the work in the actual deal that you just signed up for, that you told investors that you were going to manage their money? So you just have to be very careful. One of the most important things that passive investors can do is vet their operators. I mean, vet their operators. We actually have a program whenever we partner with people that we actually run their information to see if they have any criminal records, if they have any bankruptcies. We go through that process because these are 5-year deals, so typically they're not forever, but they're still a long time. So you want to make sure that you're protected. But syndicators, pay attention to how long and how much they're growing, because that could impact your deal. I mean, you don't care about those other 10 deals unless you got money in each of them. You care about that one. So if they're going after the other ones, who's watching this? It's just an important thing to think about. Because there is a lot. On any particular week, we're dealing with a multitude of issues at the property level. These are much larger properties, so you have a lot more things that can happen. You have more people covering it at the property manager level, and you have more people looking at it, but you have to have the people looking at it, right? If they're just chasing the next deal. So just pay attention to that. And then send reports monthly to investors. On some deals, quarterly, we'll do a more in-depth report. Some investors never look at this stuff. It's as long as they're getting paid, they got other things going on. That's why they passively invested. But some of them do start asking. And if you're a passive investor like me that wanted to do this actively, I started passively, but I wanted to be active, then I want to make sure I'm working with a team that's going to allow me to ask questions about how things work, the internals. Because if you invest with those type of active operators, then you're actually buying into that network. You're actually part of that entity, and then if you need help with something, you're already kind of in. It's kind of like foot in the door technique, right? So you're passive going into active, and that's one way to do it. This is where the asset management becomes critical, right? Property managers, their role is to keep people in, and when you have turns, they do the turns and this sort of thing. But what is the actual business plan? This is something that investors will get when you're presenting the deal to them. And for example, I mean, a lot of the deals that we were doing in the past were typically Class C properties, which are 70s property, and the strategy is we're gonna take these units and we're going to renovate them, we're going to upgrade them, we're going to make them premium units, we're going to raise rents, and then we're going to be able to sell these for a higher profit. That's one strategy. Another strategy is you buy a stabilized asset that you don't have to worry about. There's not going to be any turns, there's not a lot of things that you have to fix, but it's already stabilized, and maybe there's some money, their rents are low because they were doing a lease up. It was a newer property. They're doing a lease up, so they want to keep rents lower to make sure that there was enough occupancy. But now when they sell it, whoever buys it is able to raise those rents because now they have a lot more time to do that. So there's different ways to structure these and different business plans that each will take. So you have to understand what you're going into. Obviously, if it's a newer property, probably less problems. You don't have maintenance issues to worry about over the long term. Et cetera. But if it's a C class, you're probably looking to fix and flip it. The term obviously is not that, it's a value add, but it's basically a fix and flip. You're taking it, you're making some repairs and renovations, you're moving on, within 5 years or less. I'm in trouble now. This is the exit. This is where we sell. Now, typically, I'll explain that. Why is it that syndications go about 5 years, typically? Because of cost segregation. Cost segregation, to describe it a little bit more, what that does is it basically breaks down a property into its subcomponents, roof, appliances, whatever it is that's part of that minus the land. And when you buy a property, your typical depreciation on that property is over 27 and a half years for residential property. Well, what a cost segregation does is it's basically subdivides everything into its components, and then it accelerates that depreciation so that in your first year, typically even now where your bonus depreciation is down to 80% as versus 100, you're still able to invest. Let's just say you invest 50K, and about 25,000 of that in your first year will show as a loss, as a paper loss. So if you need to hide, if you've got, I would say hide, that's probably not the right word, but if you're looking not to pay more than your fair share, right, you're going to use this type of strategy to basically show losses, which, you know, could be from your W-2 maybe pays you too much. So you can actually offset 25,000 a year in passive losses. So this is why you do it. But after 5 years, you've exhausted that depreciation. So how do you reset it? You sell it, you buy another one, so that you can reset this cost segregation and the depreciation strategy. All right, I go into a lot more detail in the book. Shoot me a note. It's on Amazon, but on my next page here, you shoot me an email.